For more, let's welcome Sally Old, interest rate strategist from JP Morgan, to the show, and also Stephen Nash, who joins us from FIIG Securities. Can we ask you, Stephen, firstly about the global outlook that was issued by the IMF overnight in the report? It talked about the recovery being two-speed. Is the IMF right in describing it in that way?
Yeah, I think they are. I think the two-speed idea applies not only to the global economy but also to Europe. You've got the peripherals versus the main economy there. Peripherals weakening, Germany quite strong, and also to Australia, where we've got the mining sector quite strong but the rest of the economy quite weak. We've got underlying changes going on in the global economy, with Asia growing quite substantially, and I think they are the underlying causes of this two-speed growth we've got right now. And
tell us about the role the IMF explained that currency appreciation would play in terms of global economic expansion from here.
Well, that was a mention at the start of the report. I think that the idea is that currencies that aren't freely floating, for example the Chinese currency, need to appreciate, and I think that will occur, but I think the US wants quite a large adjustment quickly, but I think the anticipated trajectory of that currency is it's a gradual rise, and hopefully that will stimulate some more growth in the US economy, which is going to drive global growth.
Sally, can I ask you about the projections for Australia within the IMF report as well, because the IMF revised down its growth forecast to 3% for Australia, but the RBA's forecasts are actually above 4%. Why the large difference? Who's actually going to be right?
Yeah, good morning, Brooke. Well, the interesting thing was the IMF's last set of forecasts were drawn up in October, so quite a bit has happened, I guess, to the domestic landscape since then. We've had a rate hike, we had the floods up in Queensland, which obviously have impacted our coal exports pretty significantly in the first quarter. So forecast revisions from the IMF probably reflecting those two factors. For the RBA, you're right, there is a very big discrepancy there, and I think, to be fair to the RBA, their last set of forecasts was put together in November. We're about to get another set of forecasts from them in early May, and I think what we will probably see is significant downward revisions for the growth estimates for 2011, probably more in line with sort of the consensus of around 3.25% growth this year. So the RBA's forecasts do look a little bit ambitious, and I think probably what we'll see is less growth this year and maybe more growth in 2012, and that's certainly, I guess, what JP Morgan's own forecast for Australia reflect. We've got a number sort of around 3 for this year, but for 2012 we've got something well above 4. So it's less growth this year, but it comes at, I guess, the idea of more growth next year.
So it's not something that would scare the market then to see the RBA downgrade its forecast to that extent, right down closer to that, say, 3%?
No, I don't think so. I think that's sort of widely expected. I think most people probably look at the RBA's forecast and sort of say, look, they look a little bit optimistic given what we know on, the impact of the floods and how that'll affect the Q1 GDP numbers, and also the way the consumer has behaved over the last sort of 5 or 6 months since the RBA put their forecast together. You've got to remember that consumption is sort of, about sort of 60–65% of GDP. So, if the consumer sort of is stronger or weaker than you expect, that does have a material impact on your GDP forecast. And I think that's probably one thing that has surprised the RBA and probably most other forecasters. So I don't think it'll spook the market too much to see some reasonable downward revisions to the growth outlook near term. And certainly that's sort of largely priced by the market. Yeah. The market pricing is pretty benign at the moment, really only forecasting one full interest rate rise over the next 12 months.
And Stephen, we've got the RBA Governor Glenn Stevens, I think, in fact, speaking in New York on Thursday. What's the nature of that update expected to be?
Look, at this time, it's unclear the topic, but with the Aussie where it is, I imagine that there won't be any really major comment on monetary policy. I think that the RBA has characterised policy as being mildly restrictive. I think he'll probably restate that, and I imagine that any talk about further rate hikes are probably not appropriate given the level of the currency at the moment. So
when you just said because of where the currency is, you expect some sort of extra sensitivity given the Australian dollar at around 105?
Yeah,
even more careful comments perhaps than usual?
I think Stevens is always very careful. The comments will be very guarded, and in terms of monetary policy, he won't be giving much away. But I imagine he'll just restate what's been said quite a few times about the current state of monetary policy, and whether they take monetary policy to the next step and make policy highly restrictive is an open question, and I don't think he'll really be commenting on Thursday about that.
Sally, anything that you're anticipating out of Glenn Stevens?
Yeah, no, I think Stephen's exactly on the money with respect to the currency, and that the RBA tend to be very, very careful about what they say about the currency. And, you know, we saw it in the statement from the April board meeting. They basically said, look, the high currency helps with generating maybe a little bit more disinflation than we might otherwise have. And clearly the implication is if you have more disinflation, then there's probably less need for rate hikes. And that's sort of the way the relationship goes. I mean, I don't really think the RBA cares how they get the tightening of financial conditions, whether it's through higher rates or through a higher currency. It doesn't really matter for them as long as financial conditions move in line with the economic fundamentals, and that's sort of what we're getting. So, you know, Stevens can speak on any number of things. He can talk about sort of medium-term themes, but I sort of get the sense that, you know, right here and now, given that we're about to get the RBA's latest set of forecasts, we're about to get their quarterly statement on monetary policy, and we're a couple of weeks out from the next board meeting, I can't imagine he's going to talk in too much detail about the near-term outlook for monetary policy.
I mean, with the Australian dollar, ultimately, a high Australian dollar is a drag on the economy. Isn't it an economy like ours? Not for the US economy, but our economy that's so reliant on exports. Do we get concerned when the Australian dollar's at these levels for a certain amount of time, or how do you judge that longer-term impact, Sally?
Well, I think, you know, there's clearly very strong structural change going on in the Australian economy, and, you know, what we're seeing is the currency basically reflect that and reflect some of the sort of underlying strength in the commodity sector. That's not going to be particularly pleasant for sectors that like a low currency, like tourism or education, exports or manufacturing. But, you know, overall, this economy, you know, if what everyone thinks is going to play out in 2012 and 13, you know, growth in excess of 4%, if that actually happens, then we need tighter financial conditions. And I would actually argue that, you know, most central bankers, particularly, you know, Bernanke, and, you know, he's expressed on a number of occasions frustration with the Chinese and their inability to let their currency appreciate and reflect the genuine sort of economic conditions that are in that economy. He would look at Australia and say, you guys are doing it exactly right. You know, the currency is it's a market variable, and it moves in line with economic fundamentals both domestically and globally, and that's exactly the way it should be. And I actually think it's, you know, the RBA, for the first time in their life, have the ability to manage a terms of trade shock with a floating currency, and that is going to make their job a whole lot easier than it might otherwise have been if we had a fixed or a semi-fixed exchange rate.
Stephen, you want to comment on that one too?
Yeah, I think, look, the higher currency is doing part of the work of monetary policy, as Sally was saying. I mean, you've got a drag on growth, which is what the RBA want. Also, there's this disinflationary impact, which again is what the RBA would like. So I suppose a higher currency fits right in there. It's something that's helping policy right now. Yeah.
Can I switch into the United States too? Stephen, we'll start with you on this one. We had the budget showdown over the weekend. They managed to stave off the government shutdown for now. But then a fight on, of course, now about the debt ceiling, whether that needs to be raised, and talk of new taxes in Obama's plan for the budget. Ultimately, I mean, how significant are all of those events for markets?
Look, I think what's happening in the US bond market is that there is a large funding task for the US right now, and this political wrangling is not helping that task. They've got a lot of bonds to sell. We need clarification, and the bond market is getting a bit frustrated with all these last-minute deals. I mean, to have the budget go to the last hour there is just it's fairly critical, and it's something that the bond market is not liking. I think if this budget deal was done, you might see lower 10-year yields, but at the moment, US Treasury yields above 3.5 probably shouldn't be there. But that's because of, I think, this budget problem right now.
Sally, and so do you believe that if we had a resolution to the US budget, that would be a positive then for bonds?
Yeah, potentially. I mean, the US fiscal metrics aren't pretty by anyone's standards, and what's really interesting is you've seen countries like Spain and Greece and Portugal and Italy where their fiscal metrics aren't very good either, but they've actually started along a process of fiscal consolidation, and the US is really lagging that whole process, and I think that's one of the reasons why the US dollar is so weak at the moment. But I think ultimately, and this might not happen in the next week or the next 6 months. You know, it might take a couple of years to play out, but ultimately the market will force that adjustment, will force the US to make that fiscal consolidation, and you know, whether that comes through, you know, less demand for US treasuries and higher yields, however it comes, it will happen. And I think the thing that maybe worries the market is that there just seems such a lack of, I guess, willingness and political conviction to actually do something about the US's budget situation. And you know, the sort of last-minute deal that was reached doesn't really give you much confidence in that whole process. So, you know, our view at JP Morgan is that, you know, the debt ceiling story is going to start to become a big one sort of May. It could get extended into June and July, but ultimately it's a much more serious issue, I guess, than a temporary government shutdown, and potentially the atmospherics around that aren't very favourable for US 10-year yields. And so, you know, we're a little bit neutral on the market at these levels, but should the market rally and we see yields fall, then you know, the way we're viewing the market is that we want to use that as an opportunity to get short duration.
Yeah, and Stephen, it's interesting, there's been some more comments from Bill Gross. We have heard that he's sold out of his US Treasury holdings and actually actively selling Treasuries short to try and profit from the falling prices. But he's made comments around, I think he said, I'll just get the line, confident this country, America, will default on its debt, not in conventional ways, but he lists other ways that really he believes things are changing. He's talked about, well, this is the quote, the US will default on its debt by picking the pocket of savers by a combination of less observable yet historically verifiable policies, inflation, currency devaluation and low to negative real interest rates. Are people listening to Bill Gross with these kind of comments?
Look, I think some of those are a bit sensational, and that talking about the US defaulting, I don't think is very helpful. I think we're really at the start of a fiscal consolidation. I think, as Yellen pointed out last night, that monetary policy has to remain accommodative so that they can tighten the fiscal situation. They can cut back spending. Now, there's a lot of cutting to do, so that means the growth will suffer as a result of that. So I think this procedure of cutting the deficit will continue for quite some time, and we're at the start of this. We're not at the end.
Thank you so much, Stephen Nash from FIIG Securities, Sally Auld from JP Morgan. We're out of time for today. We appreciate your time, though.
Thank you.